Welcome, everyone. I'm Michael Harris, Vice Chair of New York Stock Exchange, and we're thrilled to welcome Scott Voss of HarbourVest. Scott, thanks for being here.
Thanks for inviting me. I'm really looking forward to our discussion.
Absolutely. I know you and I have talked a whole bunch in the past about the interplay between private public markets. You guys see a lot of both sides, and I think it's a fascinating time as we think about everything that's happened over the course of the last 6 months, but really not just the last 6 months, but really the last year plus. And you guys have been involved in a lot of some of the largest PE-backed deals, not just on the equity side of the business, but also on the credit side of the business. So I'd love to kind of get your perspective, maybe taking us a step back. How do you see the landscape right now as you look back over the last, year plus in terms of the marketplace?
Yeah, so there's an interesting dynamic playing out where there is this convergence between public and private markets. There's actually a trading that's happening between them. If you look at the companies that went public last year, the most highly valued companies, they tended to trade into the public markets at what it might have been valuations of $5 billion up to $20 billion. But at the same time, if you looked at the largest take private or buyout deals that were getting done, they were trading out of the public markets at the same price. So that seems to be the sweet spot where the two markets are trading. And then just with all the technology that's coming in on both sides, the line, I think, is frankly blurring between what is being public versus what is being private.
Yeah. And is that a function of just kind of from a valuation perspective? Is that more of a function of the sophistication of the investors that you're working with who just now have more of a preference for being indifferent between those two marketplaces? Like, what's causing a lot of that?
Well, I think what's driving a little bit of the convergence is just private markets are now able to execute at a scale that they were never able to execute at before. And there has been an overarching theme where companies are staying private longer for whatever reason it might be. And that just allows for private equity to participate in these companies at valuations that it hadn't previously. We've seen an evolution on the credit side where part of the infrastructure to get deals done in private markets is there needs to be credit available to build a balance sheet to buy a company. 10 or 15 years ago, a lot of that capital came from banks. Today, it's coming from this new source called private credit.
Right, for sure. And at least on the equity side, there's still this recurring theme where for a lot of the traditional private equity vehicles, there's been a relatively small amount of distributions that have taken place over the last 10 years. So there is somewhat of a pressure, at least from the outsider's perspective, to see a lot of companies or at least a lot of investors to try to return capital at some point. Do you see that still being the case?
So that narrative, I think if you asked me this a couple months ago, I would have said I think that will fade to the back. So one of the measures that we use to basically test the health of the markets and the liquidity that we're seeing is we look at the percentage of NAV that's distributed out through distributions. And over the long run, in our portfolio, for example, it's averaged 20% of NAV is distributed out per year to investors, but there's volatility around that. On the low, it might be 10%. On the high, it might be 30%. Over the last couple of years, we've been into the mid-teens.
Interesting.
And I felt like liquidity was going to reach up to that average 22% line this year. And even the first quarter, we had some record deals that really make the year look really good so far. But obviously, there's a lot of uncertainty in the market right now. But a data point which is interesting, private markets have cycles like all other markets. And probably the bottom of the cycle was about 18 or 24 months ago. I'd say the middle of 2024. And if you look at exit activity at the end of 2025 and take out what I call the COVID anomaly year, where there was a lot of stimulus that was put into the market to create liquidity, 2025 was actually a record year for exits in private equity, and it's kind of lost on people. So there are companies that are held in portfolios that are aging and are mature. The owners of those assets, I think, are getting to the point where they need to sell them. And when that happens, I think we'll really see that liquidity part of the market pick up.
When you look at some of the kind of industry trends in terms of the exits, what are some of the things that you're seeing? Which sectors seem to be more active?
Well, not so much industry, but it's actually an innovation within the market. If your typical path to exit would be IPO or M&A to either another sponsor or a strategic acquirer. As we just talked about, that's been a little bit more scarce than we've used to see in the past. And so the secondary market, which used to be kind of what I'd say a more tactical type of strategy within private equity, has entered the mainstream. And if those other paths to exit aren't available, the secondary market is available to facilitate liquidity for investors. And so that's a big theme and trend that we're seeing. I'd say also, if you're anywhere adjacent to this whole AI theme, we're seeing a lot of M&A happen there. It's companies recognizing that they need to AI enable their business in some way, shape, or form, and they're going out and buying that AI enablement. I think ServiceNow on the enterprise software side is a great example. They've been a very acquisitive company.
I was looking at a recent stat from some of our partners that, if you look at M&A activity, I thought was interesting. There's been about roughly a little over $1 trillion worth of M&A activity so far in 2026. That's up almost 55% versus last year.
Yeah.
And also, when you look at kind of the largest part or the most active part of the M&A calendar, it's deals that are $10 billion and up.
Yeah.
Which is kind of fascinating just when you look at just the backdrop of everything else that's going on in the marketplace.
So that's an amazing number, but I think we're going to probably talk more about this. There's a bifurcation that's happening in the market. Yeah. Captured in that number is Alphabet's acquisition of Wiz, which was a $32 billion acquisition. And also SpaceX's acquisition of XAI is captured. So you got 32 billion and 50 plus billion captured in that very impressive number, right?
Absolutely. And, speaking of SpaceX, obviously some monster IPOs that are probably on the horizon that have been widely reported in the press, whether it's that one, whether it's some of the other names that are more focused on AI. Kind of how are you thinking about this from the seat that you sit in?
That also is fascinating. These are unprecedented type of transactions. So whether it's SpaceX or Anthropic or OpenAI, they're talking publicly about potentially raising 50 to 75 billion of equity at valuations that could be 500 billion, a trillion, or 1.5 trillion dollars in size. To put that into perspective, in the U.S., the largest IPO ever by value was Meta. It happened 13 years ago. It was 104 billion. So you're talking about three companies all potentially this year being valued at 5, 10, or 15 times what has been the greatest of all time for the last 10 years. And then further, if they raise the 50 to 75 billion, this is astounding. Globally last year, there were roughly 1,200 IPOs, mostly dominated by the US and China. Combined, they all raised $170 billion. So we could see three companies potentially raise as much or more as the entire public market raised last year. Yeah. And last year was a rebound year.
Exactly.
You know this better than anybody, right?
Exactly.
So it is unprecedented. And I think when I look at those, we need them to be successful, right? Those have to be good story IPOs when they happen.
Yeah, 100% agree. Because I think the one element that kind of gets lost in that story is that those are obviously, marquee transactions. There's going to have enormous impact on the overall marketplace, but there's also an enormous pipeline of other companies that want to go public behind it. Yeah. And so the success of those companies is going to be entirely dependent on how the rest of the marketplace reacts to those small number of companies.
That's right. And I think when we look past those 3, 4, maybe 5 companies, the market's going to take you to that value that's 5 billion to 20 billion, right? Where CoreWeave and others went out last year. And I'm going to look at the health of those IPOs as much as I'm going to look at the health of the top 2 or 3 that we just talked about, right?
Absolutely.
Yeah.
Another theme that you touched on in the beginning is just kind of the overall buyout market. Yeah. And obviously last year you saw some record transactions. How are you seeing that market in the current environment?
Yeah. So last year kind of lost on people as well. I call it the greatest of all time year. We saw the largest buyout ever done, which was the take private of Electronic Arts. And then along with that, where JP Morgan stepped up and went on risk for these entire 20 billion, that was the largest syndicated loan offering, I believe, ever done.
Absolutely.
Yeah. So that was quite impressive. I think, as we alluded to before, there are a number of companies that have sat in portfolios going on now 6 or 7 years, and those owners of those assets need to look to sell those assets or perhaps trade them within the private markets. I think to the extent that the credit markets are stable and you can borrow money to build a balance sheet to buy a company, that sponsor to sponsor deal might be a comeback deal for 2026.
Interesting. Yeah. Any particular sectors that you think are going to be probably more active in this year's market for buyouts?
Well, one sector that was really active for 2 decades, frankly, was the software sector. Right. I think that'll be less active, just given all of the uncertainty around the AI business model disruption, but also capital structures that might be associated with some of those companies. There clearly is a move in our world towards infrastructure. So if you look at market share and you look at venture, growth equity, leverage buyout, then also secondary and infrastructure, you combine the secondary and infrastructure and it's actually taking share in transaction and fundraising from those other parts of the market. And part of that trend is the liquidity that we just talked about, but also the infrastructure now with data centers, power, compute, all being front and center. We need to fund a lot of these projects.
Right. I saw the recent stat was, if you look at the amount of committed compute infrastructure build out from the hyperscalers, it's somewhere between $500 to $600 billion projected for this year, 2x projected over the course of the next 2 years. The actual amount of capital that's required for the build out is enormous.
And that number is only going to go up. You can go look at reports from JP Morgan or Morgan Stanley from maybe 6 months ago, and they predicted that type of spend would be $1 trillion through 2030. And now we're already halfway or more towards that $1 trillion number.
Absolutely. You mentioned earlier, AI, you mentioned software. That narrative has been front and center, especially as you look at the early part of Q1. That's had a huge impact on the valuation for a lot of software stocks. How do you kind of think about that narrative now?
I think investors are taking a much closer look at the underwrite at the asset level of every software deal. What is their business model? How are they built? So if I wanted to simplify it, I could go back before February 3rd when Cowork was released. And a lot of what you heard is, what is the total addressable market? Is this company a rule of 40 or a rule of 80 company? What is the revenue retention rate? Those were the things that you talked about. Now you talk about, is this a vertical or horizontal SaaS company? Is there proprietary data that the customer is using to inform their decision, which is not third-party data that kind of, makes the software less differentiated? Is there a transaction layer? Does your software move money, or is there compliance involved, which makes it harder to pull out? So it's no longer total addressable market and rule of 40. It's these other nuances that are related. I think what it's prompted a lot of these companies to do, I would imagine if you're sitting in the boardroom, they're all talking about, how do we maneuver ourselves into an area where we have a bigger moat? How do we evolve our business or our business model to do that? And I think a lot of companies will be successful doing that, and you'll see it as their public market stocks rebound, and which ones are winning versus which ones are not. The other consideration is what is the capital structure of those companies? Because that's going to play another factor. If they levered up 3 or 4 years ago, debt was cheap, the refinancing window is quickly approaching, and it's going to cost them more to refinance. And that's probably going to be a bigger impact that they're not going to be able to maneuver around like they can when they involve.
I feel like there's a huge part of the narrative that is, on one part just pure business related, but the other part is just more refinancing risk related. And there's a wall of about $400 billion worth of capital that needs to be refinanced over the course of the next 3 years. And so I think there's going to be a differentiation among companies that are going to be much more impacted by that versus those whose business models are really more insulated from that. So,
and you see, if you just look at the public markets, and I think about our enterprise, core to the way we run our business every day, it's Salesforce, it's Workday, it's ServiceNow, it's Adobe. Those are the big companies. They're all facing the same pressure. Every one of those companies has seen their public market stock price decline by 25 to 40% since the peaks. So that kind of tells me this compression in valuation is pervasive, right? It's a reset of price based on what we know AI can do for us going forward.
Absolutely. And I think the other narrative that sometimes gets lost as well is that there's an opportunity here as well for some of these companies as well. And as much as there is an efficiency push that all these companies are trying to look for, there's also a revenue opportunity as well that could be unlocked.
That's right. I think certain companies are definitely positioned to catalyze their business by deploying AI and AI enabling their company. And that's a thesis, frankly, that many private equity firms are buying into. And if they do it today, they can actually buy in at a much cheaper price than they were able to buy in at maybe 6, 12, 24 months ago.
Yeah, for sure. Absolutely. We talked a little bit about AI. We talked a little bit about software. Another area that HarbourVest is pretty actively involved in is defense and defense tech. Kind of how do you see that narrative playing out over the next couple of years?
Yeah, so this is the interesting conversation I have with our limited partners right now. If you looked at our marketing decks or even the PPMs that we invested behind 10 years ago, they all talked about globalization. It was, you could get geographic diversification by investing in multinational companies that were in jurisdictions around the world that sourced globally and sold globally. But now, we're becoming much more closed as economies. And so if you read the PBMs today, they talk about resilience and national defense and, building up this capability that kind of moves us away from that unified global economy. And it's definitely a longer term thesis that I think investors are getting behind. They see it as a tailwind.
Yeah.
Right?
And that's something that's also kind of a global thesis as well. It's not just U.S. centric.
Yeah.
That's going to impact companies that are based in Europe, companies that are based in Asia as well. They're going to look at their own sovereign concerns as being something that's important from a supply chain perspective.
Like the way I think about it, we all know the U.S., but if you go to Europe, they're having their own kind of unique awakening. It's almost like a modern day renaissance because they realize they got to become self-sufficient. They have to invest in defense and other things. And then obviously in Asia, it is, although it's not only about U.S. versus China, that's kind of core to what's going on. And now the Middle East has kind of negotiated its way to the table. And it's a bit of a skilled hedger here because it can play both sides of the game. And obviously they're trying to diversify themselves away from being oil economies. And they're investing in a lot of these newer industries that we're talking about, advanced aerospace, for example.
Yeah. Do you see kind of the broader opportunities being more on the supply chain part of that set or more on the defense part of the set?
That's a good question. I'm not sure I have a great answer for it.
More company specific, maybe, I imagine.
But here, on the supply chain side, it started with COVID, right?
Yeah.
You had this supply chain disruption that you had to figure out. So I think the direction of travel started then, and it's only accelerated now that we have all of these geopolitical variables that we need to navigate.
Yeah, totally agreed.
Yeah.
I know that every year you guys come out with a quarterly podcast where you have your predictions.
Yeah.
Give us a little bit of a walkthrough in terms of some things that you're thinking, you're seeing, and what you're predicting for coming quarter.
Yeah, so I'll give you one of them. I'll give you two that are kind of playing out already. The first is just private markets executing at scale, which we've touched on. I call it the 50 billion, the 500 billion, and the $5 trillion club, and I'll work my way backwards on that. On the $5 trillion club, it's the public company crossing that $5 trillion valuation. NVIDIA was the first to cross the line, but Alphabet and others are waiting in line to cross that line as well. So I think that becomes a club of one to a club of some. Within the venture business, we've seen companies raise in the private markets at valuations of 500 billion or greater. Right now, it's SpaceX and OpenAI, and Anthropic is kind of moving in that direction. Yeah. So it's gone from a club of one to a club of what will be some. And then we touched on the EA deal, the $55 billion buyout that was the largest ever. And I think we're going to see more buyouts at that scale. The other prediction, which I was kind of vague on, it was really related to what keeps me up at night, and I call it the consensus risk trap. And in very simple terms, last year I identified the top 10 themes that I thought defined private markets, and then I fed them into an LLM, and I asked the LLM to stack rank them based on media coverage. And in the most cases, the media coverage was very positive. And I think we always have to be kind of looking around corners and assessing the risks. And top of that list was an AI valuation reckoning. I didn't think it would happen to the software industry, but it kind of happened.
Interesting.
Number two on that list was private credit. And, we all know with a lot of the news around, Blue Owl putting up its gates and some of the other redemption limitations that also has become front and center. And on that stuff, I think within private markets, they're nuanced and different from public markets, and it's the responsibility of us, the private market practitioners, to go educate the broader market so they know what those nuances are, because there is confusion around some of these things when they get reported on in the press.
I mean, I do think that there's a narrative that sometimes gets lost in terms of grouping private credit all within one bucket.
Yeah.
And there's a huge difference between certain areas of private credit versus public BDCs versus private BDCs versus, direct lending arrangements. So kind of how do you think about your own exposure? How do you think about the areas of opportunity
Yeah.
And the areas where you think maybe the popular press may have gotten the wrong narrative in terms of private credit.
So the first thing I'll say with kind of the nuance that you identified within the portfolios, it's not broad sweeping. And I think we should condition ourselves for this going forward. The dispersion of outcomes in portfolios, whether they're public or private, is going to become much greater. And the differentiation is going to be at the actual underwriting of the individual asset. For us personally, on the private credit side, we're very active. It's fundamental to our business. Yeah. We are a provider of private credit to the mid-market buyout world. In many cases, those are basic industry businesses that will probably be AI enabled, but not be AI disrupted.
Right.
And credit is critical to the cost of capital to grow a company. And so we feel pretty good about where we're positioned. But
those are also probably cash flow generating heavy asset businesses that are a little easier to underwrite. So
that's exactly right. And with all of the capital flowing into private credit and to the credit of the industry, it's innovated. But sometimes that innovation needs to be poked at a little bit, right?
Yeah, that's fair.
Yeah.
That's fair. Yeah. What are some of the opportunities that you think of when you look at areas of weakness within private credit where there's probably going to be more news that comes up over the course of the next year? Is it mostly in the BDC world, or is it?
Look, I think you touched on it. It's this refinancing risk, and what do the terms of the debt look like that you financed 3 or 4 years ago? Have you been paying interest on that debt, or is it PIK preferred, and is it growing in your balance sheet? So that's one question. I do think there's an opportunity. I referenced the secondary market becoming mainstream. That's mostly been private equity related. Because of where private credit is in its life cycle, it is now ready for a secondary market to step in and provide a liquidity solution that may not be the traditional liquidity event. And I think that's going to be a big story that we hear a lot more about throughout the year.
Makes sense.
Yeah.
You mentioned earlier, kind of the first theme was, I think about it in terms of just scale, broadly speaking. And there's been a rush to scale in many parts of the industry, whether it's the sell side business, the buy side business, you mentioned in terms of financing and M&A. Where do you see the opportunities in maybe the mid-cap area or the small cap area? Because that's obviously an area which maybe hasn't gotten as much attention and may offer an opportunity.
And I think that's a part of the market that won't evolve as radically as the larger end of the market. I think private markets are going to bifurcate. And when somebody says, do you have a private equity allocation? And they say yes, your next question should be, how do you have it? Because I think at the large end of the market, it almost looks a bit like an oligopoly. It's a winners take most that's featured by 10 firms. But when you move to the mid-market, it still looks like it has in the past, where there could be thousands of firms that are executing with imperfect information or information asymmetry. And so I think there's two opportunities there. And frankly, I think as we get more data, there's going to be a difference in both dispersion in those portfolios, but also performance in those portfolios.
Yeah.
In the mid-market, there's going to be greater dispersion, but if you're really good at what you do and you have an asymmetric information advantage, you should be able to actually benefit from that dispersion and move higher up the dispersion curve.
Right. Makes sense. Makes sense. Another area that we talked on, taking a little bit of a shift is, we talked about AI, the need for power and infrastructure as being kind of a core theme to the rollout of that area. Renewables hasn't been really talked about as much. It's been a little bit kind of put on the back burner over the course of the last year or so. But the need for power is obviously going to include renewables as a core theme going forward. Just how do you think about that as a part of just the overall investment thesis?
So this was another one of my predictions, and the headline is renewables out of necessity, not out of nicety. And in your narrative that you framed, I think is right, but it's a narrative for us here in the United States. When you go to Europe or you go to China, you can see them investing heavily into renewables.
Absolutely.
But I do believe that because of the demand for power that AI is creating, it's not going to matter where your energy comes from. Does it come from oil and gas? Does it come from natural gas? Does it come from windmills? Does it come from solar? And in fact, we're starting to see some of these massive data centers that are being built in areas where they can benefit from renewables, whether it's wind or solar.
Or space.
Or space, exactly. which a lot of people were discounting as little as a year ago. And now there's some amazing companies getting funded that are going to put data centers in space.
Absolutely.
Yeah.
Absolutely. I mean, it's interesting because there's a fairly large number of companies in the IPO pipeline that are looking at whether it's providing the production capabilities for companies to actually launch data centers in space or providing infrastructure around that. It's a big part of their growth narrative.
It's totally changed the calculus, right? Like even here on Earth, if you're going to build a data center, you're probably looking up in the Nordics where it's cool, right? Where you don't have this heat problem.
Right. And less a regulatory constraint too, which is the other issue.
Yeah, that's right. That's right. Yeah. So I think that part of the market will be really interesting to watch. And I think the question I have for the U.S., if we're not investing in that type of infrastructure, renewable infrastructure, are we at a disadvantage down the road when it actually becomes strategic to actually own that type of infrastructure?
Right. Yeah, because you mentioned earlier, probably the biggest investor in that space is probably China.
Yeah.
They've been making a very strategic, very long-term bet, whether it's battery innovation or solar power generation. They're probably the best positioned in that front.
Yeah.
So where do you see some of the areas that the U.S. is probably best positioned in terms of the renewable space?
That's obviously we have access to oil and through fracking. So this whole Strait of Hormuz, we played a significant role in creating that problem, but we're not actually suffering as much from that problem.
Right.
So I think that and also through technology, right? Technology and innovation is going to allow us to run some of these consumers of power and compute in a much more efficient way than we can right now.
Absolutely.
Yeah.
Absolutely.
It's interesting. We're going to be publishing a paper either tomorrow or early next week that talks about the redefinition of sovereignty through an investor's lens. And it talks about all of these strategic positions that major blocs around the world, whether it's the US, Europe, China, or the Middle East are taking. But then it also talks about these idiosyncratic others. It might be Israel, it might be Turkey, and what role do they play in this new global economy that we're going into? And then finally, it's the pseudo-sovereigns, right? They own all the technology, they own the infrastructure, and they deserve a seat at this sovereignty table as well.
Right. And they're well capitalized.
Yeah, that's right.
That's
right.
Can you give us a little preview of some of the takeaways and the kind of broad themes that are going to come out of that piece?
So I think the headline here is, and we touched on this, it used to be one big global economy, and now it's not. We're investing in resilience, we're investing in national defense, and everybody's kind of looking out a little bit for themselves, right? And capital could be the kingmaker here. So those that have access to capital are probably going to be the ones that win in this new world of competitive advantage. I call it Porter crowding out Ricardo, where comparative advantage is now being displaced by competitive advantage.
I mean, I guess in a big picture theme that kind of helps or benefits the U.S., center of capitalism, center of capital markets, largest developed capital markets. Do you kind of agree with that narrative, or how do you see that playing out?
I do, and I spend a lot of my time traveling around the world. And frankly, the U.S. has alienated itself from certain parts of the world. But generally, I'd say investors take a view that you need to be investing in the U.S. So if capital is there and it's available, I think the U.S. has all of the other variables that you need to maintain a leadership position as a block, right? But does it maintain the leadership position as the kind of global caretaker of the world? I think we've kind of moved away from that, right?
Right.
Caretaker is probably the wrong word, but
that's probably true.
Yeah.
But I imagine you probably have the same observation that I have when I meet companies that are private as well. When they look at the ecosystem of potential investors, whether it's public or private, the U.S. marketplace from a capital markets perspective is almost unrivaled. There are obviously some fantastic investors outside of the U.S., but the complexity, the depth of capital in the U.S. markets is very, very difficult to compete against.
Yeah. I mean, people talk about the bipolar world or the multipolar world. Is it China, U.S. dominated? And this is kind of where the Middle East sits in an interesting place because they are the source of capital and they can play both sides, right? Where it's probably not as easy for the U.S. to invest in China or vice versa.
Exactly. Exactly.
Yeah.
Excellent. What are some other interesting themes that are coming out of the next research piece that you're working on?
So I think that the part that we're going to continue on in this research piece I just told you about is the pseudo-sovereigns and the role that they play, where sovereignty is no longer defined by geographic borders. It actually moves into into the data world, right? The digital world, and as a result, you look at recent events where Meta tried to buy Manus and it got called off by the Chinese government, or the conflict that Anthropic had with the Pentagon, right? Like all of this stuff is converging, and it's really, really fascinating.
Yeah. And I guess kind of before we leave for today, give us kind of like 3 takeaways, how you're thinking about the world. What are the 3 opportunities that you see? What are the 3 risks that you see in the marketplace right now?
Yeah, look, I'm going to go really macro on this because they are the opportunities for investors to outperform, and they're also the risks if they don't take them seriously. The first is because of the complexity of the world and because of the dispersion that I talked about, I think really informed portfolio construction is critical, right? And there's data that you can use to inform you to kind of build the optimal portfolio. Second is diversification, which is fundamental, but sometimes we lose sight of it. There was a period of time where investors said they looked at the software space and they said, I should invest in nothing other than software. Well, today that looks like a mistake. But the final one is investors should always be underwriting and re-underwriting their existing portfolios. In the case of SpaceX, there were some investors that were brought a liquidity option 5 years ago when it was valued at $100 billion, and it was a phenomenal deal. Some decided to take that liquidity. They like what I'm saying. Some decided to take that.
Would have been a terrible idea for them.
But look, some decided to take that liquidity. Some decided to re-underwrite the company, and now it's 10 to 15x later on their money. So these are very fundamental. But I think we're in a world right now where you need to not lose sight of the fundamentals. Yeah.
And then on the other side, if you look at kind of 3 things to be wary of, 3 things to look out for coming forward to the next year.
This is again very macro. It's the consensus risk trap. If I would tell any investor, if somebody's sitting across the table from you selling you a strategy and telling you it's the golden age of, you should at least pause and reassess every variable that you're assuming, because I don't think we should ever be that blind to the risks that live around the corners. To the extent that you can be contrarian in parts of an asset class that have long-term durability, you should probably do that. Right? And we kind of touched on that a little bit in software. Everybody's running away from software right now. Well, maybe now's the time you should be leaning in, and you shouldn't have been investing when it was the golden age of SaaS.
Exactly.
So I hope that answers your question.
No, absolutely. In many ways, it's kind of like it's back to the basics, right? It's like take a nuanced view, be diversified, focus on the fundamentals.
But I do think, in the public market world, they call it active management versus passive investing. And in our world, it's different, but it really is about the individual underwrite, because if you just choose the software sector, the AI business model disruption affects different companies in different ways. And what you bought in at versus and how you capitalized your company is going to affect different companies in different ways. So you can't paint it with a broad brush.
Absolutely.
Yeah.
Great.
Thanks, Michael.
Scott, thanks a lot for having me.
Thanks
for
for
being
having
here.
me.
Really appreciate it.
That was great.
It's a lot of fun.
Thank you.
Thank you.